In this video, we're going to have a look at Philips Group, which is the Dutch multinational which is known for selling electronic goods. And we're talking about medical supplies, like things that you see in the hospital. We're talking about consumer electronics like electric razor blades, and we're talking about things like Philips Hue, which is their smart bulb franchise. Now, in the corporate world, Philips is known to have made some questionable decisions along its lifespan. I think the biggest of which will probably be the fact that they spun off a part of their company known as ASML in 1995. They IPO'd for half of their shares, they put half of the shares up for public market, and then they sold the remaining half in the years following that. Now, of course, we know now with the power of hindsight that ASML has become one of the biggest, if not the most important company in the world, at least in Europe, but definitely the world as well. And they used to be a part of Philips. Now we're talking like decades ago, we're talking like 3 decades ago, so like maybe let's not look at exactly the mistakes that Philips made in the past, but let's see what Philips has been doing for the past 10 years and see whether or not we think that Philips Group is an interesting investment for us right now, and whether or not if we hold the stock now, we buy the stock now and hold it for, let's say, a decade, do we think that we have a proper return holding Philips Group? So just starting off here with the revenue, already the first red flag kind of comes towards us, which is to say that their revenue is decreasing by 3% year over year. 23 billion in 2012, but it's decreased all the way to 17.8 billion here in 2021. Average decline of 3%, which is already like something that we don't like to see. Whenever I buy a company, I want to buy a company that has some future prospect. I want to have a company that has some growth embedded into their business. And this is not something that we see with Philips. We did not see a top line revenue growth. But looking at the very next column, we can see that earnings before interest, depreciation, taxes, and amortization. And what we can see here is that the earnings actually have been growing relatively well. It says here 11.7%, but this is mostly because 2012 was a bit of a low year for them. So let's say we normalize 2012 to be more in line with the numbers right next to it. And we can see that still Philips has been growing by about 2.5% year over year. So this means that the margins are very much increasing, even though their revenue is decreasing. And I think, if anything, this kind of shows that Philips has become more of a mature company and not so much one for growth. They're mostly focusing on reducing their spending, reducing their costs, and trying to maintain their current market share, which is also something that we saw with other companies as well, like KPN, who are not investing into growth anymore, but are very much investing into becoming profitable and increasing their margins. So looking at that debt level, I think there's not really that much to talk about here. 700 million in 2012, risen all the way to 4.7 billion in 2021. Now I think it's important to note here, 2021, what we see is a reduce in earnings and a massive increase in debt, as well as a reduction in cash on hand. So what happened in 2021 is that one of the medical equipments, I think one for sleep apnea, was actually malfunctioning and was causing serious injuries to the patients who were exposed to this. So they had to recall basically all their equipment and fix it up and send replacements to every single hospital that they sold this equipment to, which were quite a lot. So as you can imagine, this really hurt their earnings, this really hurt their cash flow that year. 2021 was not a good year for them. As we can see here, we can see that debt has been increasing 4.6 billion, 23% increase year over year, which is quite fast, I do have to say. But I think that earnings more than cover it. Looking at excess cash on hand as well, there's not much to say. It's always been ranging around the 2 to 3 billion range. 2021, even after the entire calamity of their medical equipment not functioning properly and having to recall all of that and all the expenses that come with that, we still see a good number of cash on hand in case they mess up another one of their equipments in the future. They can cushion that blow, although maybe not too often, so try not to do that too much there. Philips. Looking at market cap, we see that the market cap, so the price on the stock market, the stock price itself, has been increasing by about 5.7% year over year. Enterprise value is the full value of the business, so this means that the market cap to which we add the debt and subtract the cash. It's the entire value of the business. So let's say they spun off ASML 3 decades ago. If ASML now is interested in buying back their initial parent company, of course what ASML has to do is buy the shares from the stock market, which is the market cap, but on top of that they also have to incur the debt that Philips has, and they get to keep the cash, although most of the time I think actually the cash gets divvied out to investors. But let's say for the sake of argument they can keep the cash if they choose to do so. Then all those combined contain the enterprise value, which is the full value of the business. So looking at EV/EBITDA, this is the ratio which is used for valuations and used for future projections. And basically what it says is how many years does it take for Philips Group with their current earnings to pay down the entirety of their enterprise value. How many years does Philips has to operate before they can buy themselves back entirely? And we can see historically it's been at around 11.4 times, which I think is quite accurate given all the multiples that we see here. It's kind of ranging between the 9 to 13 times. I think 16 here was a bit of an outlier because that earnings was so low this year. It was an absolute, this was absolutely an odd case. So I think overall 11.4 is a very steady number for Philips. Looking at the debt multiple, we can see that here in 2014, of course, is a bit high, 2015 as well, because their earnings have been relatively low. But by and large, I think they can very much cushion their debt with the earnings that they have. So Philips is not a risk for us as investors for going bankrupt, at least anytime for the upcoming years. Of course, if a few more equipment malfunctions do happen, it will definitely increase this number, this multiple, and it will become a lot more scary. But as of right now, Philips is not at a risk of going bankrupt. So that brings me to the free cash flow, the cash flow statement. This is where the rubber meets the road. This is the cold hard cash that Philips is making. So in 2012, what we saw was 2 billion in cash flow from operations. Now, cash flow from operations is all the cash that they make simply from operating their business. It's all the materials are included in this. All the manufacturing costs are included in this. This is really just the cash money that they made from running their business. Well, we can see it was 2 billion in 2012. And it's reduced to 1.6 billion here in 2021, which again is partly because of the equipment failures that they have, which reduce their trust, which reduce their earnings and their sales. So I think this number will probably come back up a little bit in the future as they have more steady results again. But at least for 2021, their cash flow has been down. Looking at capital expenditure, this is all the investment that they have to do into new facilities, into research and development, into additional company cars, into anything really that they need to keep future-proofing their company. And we can see that their costs on average have been increasing by 1%. So I think overall this kind of means that they've been really able to keep their expenditures at a very steady level. Looking at free cash flow, now free cash flow is what we get when we take the cash flow and take away the capital expenditure. Now usually what you also do is you look at whether or not they borrowed money or paid down money, but I decided really not to look at that because I just want to see whether or not their operating margins are proper enough to actually give us a nice cash flow. So looking at cash flow, we can see 1.4 billion here in 2012. 900 billion in 2021, which is again mostly because their cash flow from operations has been quite low. The year prior to this, 2020, they actually had a record cash flow, and I think maybe in the future we will see some of this as well. Shares outstanding, they have been slowly but surely reducing the shares outstanding. Now it's not really fast. 922 million shares in 2012, 904 million shares in 2021. So this basically means that our ownership of the company is increasing, even though we're not buying any more shares. It's simply because Philips is buying back shares and basically ripping them up. They're taking them out of circulation, which very much increases our value as the shareholder, and is always something that we very much like to see. Free cash flow per share, not much to say there. It's kind of the free cash flow divided by the amount of shares. Now, because they're buying back shares and their free cash flow is remaining relatively steady, we can see relatively steady numbers here as well. Price per share, as seen on the stock market at the 1st of January, we can see an increase on average of about 6%, just like the market cap. 19 euros in 2012, reached a peak here of 43 in 2020, almost down to 32 here in 2021. And what we can see now as well is that that price has come down even more. Free cash flow yield on average 3.2%, which I think is on the low end, I think, for a company like this, because I do not see that much growth with them, and I do expect these numbers to go up a little bit. Now, I do have to say 2022 was also a bit of a scary year for them, because they still had to incur the cost that came from their malfunctioning equipment. So they definitely have increased their debt level. Their earnings have decreased this year as well. So when we look at our projections in a little bit here, and we look at the share price, we can see that it's come down quite a lot, but we'll get to that in just a second. So just looking at EBITDA, earnings before interest, taxes, depreciation and amortization. 2021 they posted about 3 billion in earnings. Now it says here on average they've been growing at 11.7%, but I think for the past 4 years ish they've been growing at about 2% annually. So I'm going to give them, into the future, I'm going to give them this 2%, because I do think they can grow their earnings a little bit. I do think they've been showing that consistently, that they've been able to grow their earnings even though their revenue is decreasing. So I'm going to give them 2% earnings increase year over year, and then reduce it to 1% in the final 5 years. So doing this with a market multiple of 10 times. Now historically they've been at around 11.4. For the past 3 years they've been a little bit higher than that, but I think it's going to come down, and I think 10 is a nice conservative estimate, almost about as low as they've ever been, and I'm going to use this as my conservative estimate for when I make a forecast into the future. Because when I make a forecast, I want it to be as conservative as possible, and if my conservative estimate beats the stock market, that's when I'm going to be interested in buying the stock. So with a multiple of 10 times gives me an enterprise value of 34 billion, to which we subtract the debt as the cash, gives me a market cap of 32 billion, divided by the amount of shares outstanding, gives me a stock price 10 years from now of 35.69 euros. Now we're going to do a similar thing here for the free cash flow model. I'm going to take the free cash flow from 2022, which was not a good year for them, in all fairness, right? The year prior to this, their cash flow has been a lot higher, but I want to be conservative, because I'm not sure whether or not they'll be able to sustain this high of a cash flow. And I think, especially in the business that they're operating in, medical equipment, which I think is a bit of a risky thing, and sometimes things can go wrong. So I'm going to give them the free cash flow of 2021, and I'm going to increase that by 1% year over year. So I'm going to increase it less fast than their earnings is, because I do think they have to do additional research and development into the future to really stay at the cutting edge there of medical equipment and medical technology. So I'm going to increase it by 1% a year. I'm going to give them a free cash flow yield of 4%, which is on the higher end of their 10-year average. On average, they've been at 3.2. Their highest number has been 7.9 here at the year of 2012, but on average they've been circling around the 3 to 5% range. I'm going to say in the middle of that, I'm going to say 4%. So this gives me a stock price 10 years from now, according to the free cash flow method, of 27.49 euros. Now what we see is that the price of Philips has been coming down drastically. They've really been hammered in the stock market recently with the entire economic downturn coming up. Philips was definitely one to hurt the most. Right now, as the making of this video, their stock price is 15.99 euros. So given our two projections into the future, the enterprise value as well as the free cash flow method, I get an average price per share of 31.59 euros. When I look at just the price increase on the stock market, according to the share price on the stock market itself, I expect an annual growth of 7% year over year. Historically, they've been doing at about 5.7%, but I think because the price has come down so much, our projection is a little bit higher than that, because I think Philips right now might be a little bit underpriced. Now, when we take into consideration the free cash flow as well that comes with holding this stock, because I do want to clarify that Philips is very much cash flow positive. They do make money every single year, and of course every surplus of money is going to be handed out to investors, either in the way of a dividend or for them buying back shares, reducing their debt level, or maybe even investing into something else. But either way, that money is used to better you as the shareholder. So of course you are entitled to that piece of free cash flow as well. And if we include this free cash flow into our calculation, we get an internal rate of return of 14% year over year. Now, on average, I always say the stock market returns about 10% a year. So if we take that into consideration, I think that currently with the current price, Philips will outperform the stock market by a little bit. But of course, you do have to realize that Philips has a bit of a tricky record for the past 2 years, where they have made some bad business decisions. That technology wasn't entirely working properly. There were some checks and balances, I think, that did not operate properly. And so if they do that again, let's say 1 or 2 more times, I think Philips will be in serious trouble. So I think that's definitely the risk that you accept when you buy Philips Group. But if that risk is okay to you and you very much like, I don't know, like their products, like their Philips Hue, you want to be a part of the company, then I expect an internal rate of return of 14% for you to hold the stock. Now, what happens if the stock price comes down or goes up a little bit? Let's see what happens. So, if the stock price comes down by about 10% to 14 euros and 39 cents, it gives me an IRR of about 15%. Do I think that's enough to take the risk of this company? Maybe, actually. I gave it a relatively conservative estimate, so I definitely think they'll be able to reach this 15.7% if the stock price comes down. Now, if it comes down even more, all the way to 11.5% with a 20% IRR, I'm going to be very interested in the stock, and I'll definitely have a deeper look into it. But as of right now, I think there's a bit too much risk for Philips Group, because they're on the cutting edge of technology, and if something goes wrong, it can turn out quite bad for them. But if you're willing to take that risk, I think there's some pretty good returns to be had here with Philips Group. Okay, so that was it for this video. Thank you very much for watching. Don't forget to like, subscribe, and all the good stuff, and I'll see you in the next one. Cheerio!